Alright, hello guys, glad to have you on buddy. And today, you know what time it is. Sorry about last week, it was totally skipped. I simply couldn't find out the time to record that video, so sorry about that. That means we have 2 weeks to catch up on this time around, and boy, it has been hell of a roller coaster. Remember, we have mentioned back then that we were still under the influence of a volatility pattern, reason why personally I have bought this market in these nearby areas, I think this bottom as well, and I was kind of held underwater. Like I said, my stop losses were wider enough due to this volatility pattern, and like I said, I don't know if I'm going to be taken down by the markets or not. It turns out I wasn't, and hell of a reverse has happened. Now let's just look at what happened in the kind of appropriate time frame. Remember, these things are happening in the H1 time frame. But before we dive in, let's just remember the overall picture and the actual questions we had back then. Surrounding the uncertainty in this area, we were like, okay, maybe we could have a double bottom. That wouldn't necessarily be a problem. If we get to clearly break out below that level, that will be the sign that a third flow has triggered. So now we definitely know for sure that this third flow has happened. Now let's just zoom in into the 1 hour chart time frame to see how this game played out. Because as you would see, it wasn't an easy thing for the bears to navigate this thing. First and foremost, remember back then, like I told you, I was waiting for these Bollinger Band prices and I couldn't get filled, which means I wasn't into that bear trade just because we gone close, very close to the entry prices I wanted, but simply didn't really have them. So I said, if this third flow pulls itself, I won't be part of it just because it came close, but not close enough to trigger my trades. That's where the way it goes. I have rules and I had orders, pending limit orders, didn't really got filled. That's the story of it. Though not a big deal. That means, like I said, if it goes down, it's going to go down without me. All that matters is I bought those areas, these ones, and if I get stopped, well, I'm going to take the stop loss. I'm not going to cry around, and I'm just going to say, okay, that's the way it is. Though I haven't been stopped, and frankly, the way it is, I'll explain why I took my profits earlier this week. It turns out to be profit, actually. So like I said, I was wrong. It has been a third bearish flow instead of a bullish one, and still I managed to make a gain out of this. So that's the beauty of risk management, and it's going to be 2 days kind of topic. Okay? How? By simply following a simple set of rules. You're not going to be able to forecast the future, but you're just going to navigate this uncertainty the best possible way. There's no way for you to know how it was going to play out, and sometimes prices will just go hinge away from your stop losses and then still deliver some kind of a gain. Okay, so now let's just sum it all up together. For those who were in this bear trade, like I said, got close enough, but not close enough to me to get in. But for those who were in, I mean, look at the way it's played out. We've squeezed the prices at the double bottom and we extended down, okay? The bottom in here had absolutely no way to be detected. We broke through targets, okay? The third flow has pulled itself, meaning the moving average moved away from the context, and then, hey, no third range boundary. Remember, when you're in a flow, you let yourself drive that flow so long as there's no third range boundary. We've gone from context to context, reversed it, and instead of just pulling back here for the bears to take their profits, we kept flushing them away, which means any bear now, and just look at it, we're making new highs. That means all of the bears are taken down. Remember, even those who had this perfect entry price in here, they were supposed to put their stops at break-even out there. When you break the previous low point, this is where you put your stops at break-even. That means for the bears, there were no exit. They were flushed, reversed in a V-bottom, and they are now taken off at break-even. That means we flushed out all of the bears. So if we have that into perspective, let's just figure out what happened in the bigger picture. So we had that volatility alert, somewhere like that. I'll give it a second to plot. And remember that it was lasting for approximately 6 to 7 context boxes, which, like we've mentioned, might somewhat terminate mid-November. So we said for another probably couple of weeks, we still risk volatility. That's the reason why, like I said, keep large stop losses. Don't be dumb enough to put stop losses below these lows. You could be taken down. Though the thing is that all I would tend to say is that those who did go for the option of very tight stop loss, they've been stopped. And then, for those who were bearish, they've been stopped as well. That means, frankly speaking, I think all we've experienced throughout the latest 4 to 6 weeks is just volatility, period. That means this was just chasing down stop losses, absolutely not going anywhere. And if you have a look at it, just plain simple, 7 weeks later, where are we? Exactly back to square one. Exactly where this pattern started. If you have a look at the broad big range which we're in, that's actually the middle of this range. So the reason why I decided to take my profits in here is just because of this. I think we've been absolutely hammered by the market makers. They've played a fairly freaking dangerous game by managing volatility and creating spreads all over the place, taking down stop losses of those who were too greedy, and in the same time not going anywhere. So that's what I would tend to say. I had some gains, we were back to square one, took my gains, and I'm not nearly overthinking this thing. All I know for sure now is that we had 3 sets of bear flows, which means if I want to go bear again, I need to let 2 sets of consecutive bullish flows now, corrective flows. This could be the first one and still have a few days to go by in terms of fuel. Remember that the context has to at least go to the moving average or above it. Give it a second. Okay, so as you can see, the moving average is now trading at 42.73 and the context is rising and should somehow match in, let's say, another couple of days. So if the bulls can still hold it on for a couple of days, that doesn't mean they need to grind higher. They just need to keep the prices high enough not to reverse this context until it crosses the moving average. If it does, that means we have our first flow. Remember, that means the bears will have another corrective flow and then the bulls should strike another one, okay? A second bullish flow. By the end of that second bullish flow, only if we are in the big weekly resistance area, remember that's the one that we have here, so if you have a look at it, that means if we retrace back up to 44.50 or of some sort, that's the area in which I would be eventually willing to sell again. That doesn't mean selling to the cave and stuff like that. Once again, just means this weekly area seems like it's reacting. It's been pulling out 3 bearish flows. Okay, 1, 2, 3. That means if the bears can still sustain 2 consecutive high flows, that means now it's the bulls' time. It's to push 2 flows. And if they manage to constrain that bullish volatility, then that means I'll be ready to set eventually another set of 3 bearish flows to the downside. But that's all there is. Remember, once again, I do follow the path. I don't care about where the market goes into the long run. When it comes to trading those short-term time frames, do it dumb. Do it the way it is. You know the sequence and you apply it absolutely dumbly. So now it seems like the weekly area is responsive. It's responding by 3 sets of bearish flow into the H1 time frame, corresponding to a bearish resistance area in the weekly chart. So that's the way it goes. The weekly third range boundary we have seems to be having reactions in prices because they managed to pull a set of 3 flows. That doesn't mean we're going to put another set of 3 flows later. Remember that. Just put it plain simple. We could very well go all-time highs now. So the way it is so long as the bears can maintain 2 consecutive bullish flows without making a new high, I would be eventually willing to start another set of trade flows. Remember that I never trade the first flow. I trade the second only and the third one. So I will be waiting for 2 sets of bullish flows and eventually the beginning of a new bearish one. And only by then will I start trading the second. Okay? So that means for now and until further notice, I don't nearly give a fuck about the S&P 500. We're terminating this weekly pattern, which says volatility. It's exactly corresponding to the big middle of this absolutely messy range in which, frankly, I think everyone has been just washed away. So, frankly, I don't know anything. All I would tend to say is that those flow charts, trading type time frame, are very conflicting. And by the way they are, I would tend to say I'm lucky enough I was able to take some gains out of this instead of losses, which I think many people ended up getting through. And therefore, well, that's the way it goes. I'm taking my profits at the mid part of the range, letting it go now, and I think we should be stepping aside from this trade for now. Let it play out. There's too much uncertainty to try making some forecasts. So I would tend to say the bears might have something to do again, but it's certainly not now. They might have things to do in a future, letting 2 sets of bullish flows before they start again. Okay? For the bulls, that means, well, normally either you keep your previously open trades and you're going to hope now to break the previous high point when you're going to be able to put them at break even, or just like I did, you would say, okay, you know what, it's noisy, I'm going to let it play out, take my gains and get out of this. That's the way I'd chosen. That doesn't mean this is the way you need to choose either. Well, this is once again, remember, open choices for you. It depends on your assessment of risk taking. The reason why I am getting out, and I answer this question very frankly, is because I do have some exposition to the upside on the S&P 500 through the portfolio that I have. So that means doubling down with bullish trades on the flow time frame is just increasing my risk if for whatever reason something ugly were to show up. I certainly don't believe such a thing, but like I said, the reason why I take profit is because I have external exposition to this very same upside potential. Otherwise, I would probably have kept those trades. Okay? If you keep them, of course, that means the initial stop loss that you had, if it hasn't been taken down, still needs to be where it was. There's no way for you to move it. Remember, you don't move the stop loss until you break the previous high point. If we cross over 4,500, this is where you're going to be able to put it at break even. Until then, just let it be. If it goes to your stop loss, don't come cry. If it goes to your targets and validates your trade or confirm your trade, then you move your stop loss, and certainly not before that. All right? That's going to be it for the S&P 500. When it comes to crypto, well, we're 4-hour chart time frame, same old story, Bitcoin is going up. The context are far from being reversed. That means the bulls still have it under control. The bullish context in here, as you can see, is now crossing over the rising moving average, which means we definitely have confirmation of a third flow. And in here, well, so long as we don't retrace down to 30K, which is where the support context currently stands, well, there's not even a remote chance for the bears to take it over. That means the bulls have it under control and they need to let it ride. So long as there's no third range boundary, and when it happens, you take your profits afterwards. So that's really the way it goes. Let it ride for now. I see people crying for Bitcoin to do either this or that. I mean, frankly, just don't give a fuck and let it play. And so long as it doesn't retrace significantly enough, there's nothing to worry about. Just be in that train and let it push higher. It doesn't have to do it next week or the week right after. Just have to let it ride and don't try to dictate your timing to the market. When it comes to Ethereum, well, same story in here as it was a couple of weeks before. That means we're still into this flow. I'm going to zoom it out to the higher time frame so you get a broader picture of it. Remember, this is where we've rejected these third range boundaries 2 times in here. So definitely 2000 is hell of a resistant level for ETH. This is where all the stop losses will trigger, of course. The bears will be proven wrong there. But if you bought, remember, this is the area in which you should have bought. This is where the Bollinger Band was for the third flow. So don't buy below resistance. Once again, don't be a dumb, be a smart. Buy when you have to buy. Don't let yourself influence by the bears back then who said, yeah, ETH is going $500 or whatever shit that is. Okay, you know that. You let them talk. If this thing breaks above the previous high point, which isn't 2000 but 2140, if we get to cross this level, only by then you can put your stops at break even. Until then, let the dumb talk. Just don't be bullish, don't be bearish, be right in between. Let the uncertainty sink in. Just take in and don't try to fight against it. It took me years to figure that one out, and you're gonna have to figure it out as well. It's really the way it goes. There's no other way but to trade flow trading without any external assumptions. Don't listen to the news flow, don't listen to the dumbs, don't listen to anything. Just look at your charts, follow your guidelines, and if you repeat the operation sufficiently enough, you would be able to see that, yep, sometimes it doesn't work, sometimes you take a stop loss, sometimes you get proven wrong, but you're still not taking a stop loss, just like we're proving it today. So long as you have a good risk management, sometimes you might be wrong, but still make a nice gain. So that's really the way it goes. The end is that net over 100 trades following these guidelines pure and simply. Well, frankly, I doubt there is a chance to lose money out of 100 trade. Could still happen out of 100, but there's no way you will lose out of 1,000. So that's the way you go. Like I said, this is a simple way of trading, but it requires you to, of course, be able to figure out the low risk management time frame. So remember, you can't flow trade if you don't know in which time frame to do it. And the only way you can assess the time frame to perform these actions and these sequences is if you are able to figure out the value. So once again, it all happens in the larger time frame. TLDR, this is the true thing. This is where the tricks actually stand. The patterns are freakingly simple to play out. But if you're stupid enough to think you can play them out in any time frame suitable to you, that's not how it works. The market dictates and you follow. If the time frame changes from 1 hour to 4 hours, you're going to have to change as well. And you don't have the lead. The market does at all times. And if you can understand that, well, you're going to be a successful flow trader. Otherwise, if you just think you can trade one asset in the H1 time frame forever, good luck with that. That's exactly the number one mistake that people are doing. They're not adjusting to market conditions. You need to. So be smarter than them. That's going to be it for today. See you guys next week. Bye-bye.